Okay, let's do an example um, in which we'll be calculating the value of control. Now, value of control is a slightly different concept as compared to synergy. In synergy, we look at the merger of two companies and the incremental or marginal benefit that can be captured by the cost saving and revenue that will only be possible post merger. That is what we value when we are looking at synergy. In control, the assumption is that the current management of the company is not really performing their job as they should, and therefore, if we were able to change the management of the company, we would be able to see improvement in the bottom line. So we are trying to assess the value of control in Amco, a troubled automobile parts supplier. You have the following information. The company is expected to generate $48 million dollars in after-tax operating income next year. So next year, EBIT into 1 minus T is 48 million on a book value capital investment of $800 million. So whenever this number is given, you can automatically assume that in 90% of the cases you will be required to calculate the return on capital. So 48 divided by 800 would be your return on capital, which comes out to be 6%. The firm currently is extremely over levered with a debt to capital ratio of 80%. The levered beta of the stock is 2.72 and the pre-tax cost of debt is 12%. Tax is 40%, risk-free rate is 4 and market risk premium is 6. So highly levered firm. So I would assume that the management would be reducing the debt once they take over. You believe that the new management can turn the firm around by restructuring the firm's financing mix to make it 50% debt and 50% equity, right? So they will be either retiring some of the debt or maybe they would be raising some more equity, which would result in this debt to capital ratio coming down from 80% to 50%, improving the after-tax return on capital on both existing and new investments to 9%, right? So at this point in time, we have a return on capital of 6%, right? And which is the current return on capital. We don't have much of an indication of whether the um, return on capital on new investments is different. In this case, we would assume that the new investments are also yielding a 6% return on capital. So when the new management comes in, they are confident that they can increase the return on capital on new as well as existing investments. We will turn to this topic in a while on what do we mean by new and existing invest returns on capital being different or being the same. Assuming that the firm is in stable growth, growing 3% a year in perpetuity, estimate the value of the firm today. So the first question is, we need to value the firm as it is. For that, we need three inputs: the FCFF expected next year, as is FCFF1, the WACC, and the growth. This is given. Growth rate is given. It's 3%. WACC is it's something that you can calculate. You've got the debt to capital, and which means that you have the equity to capital as well. You have the components of the cost of equity: 2.72 beta, 6% market risk premium, and 4% risk period. So CBC means it can be calculated, and FCFF1 is that you have EBIT into 1 minus T, and reinvestment rate can be calculated by G divided by ROC. G is 3 and return on capital is 6, so 50% reinvestment. So you have all the inputs that are necessary to find the value of the firm. I have hidden the actual calculation. This is the actual calculation. So you find first the expected free cash flows to the firm, which is 48 into 1 minus M7. M7 is the reinvestment rate, and here it is 50%. So the value of the firm is $351.7 million dollars today. Coming back to the question, so estimate the cost of capital if new management is able to restructure the debt in the firm. So by reducing the debt from 80% to 50%, how is the cost of capital of the firm going to change? The existing cost of capital is 9.82%, right? So in order to find the new cost of capital, as we've seen, we need first, we have the current levered beta. We need to unlever it first by using the debt to capital ratio of 80%, which basically means the debt to equity is 8 over 2, which means 4. Debt to equity is 4. Right, so you unlever it, find the unlevered beta, use the new debt to equity, which is 50 over 50, meaning 1. Right, so um, the new levered beta can then be calculated, and from that you cost the new cost of equity. Using the new debt to capital, which is 80%, you can find the new WACC, which comes out to be this 8%. Right. So let's just have a look at what the um, uh, calculation looked like. So you had zero point 0.8 as your unlevered beta, in which you can see 8 over 2 is the debt to equity ratio that is being used. Right. So new levered beta uses a debt to equity ratio of 1. So that's the answer to the question. Lastly, C part requires that assuming that the firm will stay in stable growth, growing at 3% a year, even with the new management, estimate the new value of the firm. So one part we've calculated, the when you value the firm under the new management, the WACC will change, and we've calculated what the WACC is going to be. The growth rate is going to stay the same; it is 3%. What about the free cash flows to the firm? How are they going to change? So the free cash flow to the firm is going to change because of the change in the return on capital that is expected. So this improving the after-tax return on capital both on existing and new investments. Now, to get back to that point about how what do we mean by existing and new investments? So the existing investment is basically next starting from time zero or standing at time zero. The existing return on capital means what is the EBIT into 1 minus T that you are going to get, or it is expected in the first year. So that is the only um, interpretation or reason for using existing investment return on capital, which basically means if you've got a book value of invested capital of 800 million here, and and you have a return on capital of 6%, you are going to get a $48 million EBIT into 1 minus T next year. Right, so this is the existing uh, the return on capital that you get on your existing investment. The new investments are the ones that you are reinvesting year on year, which is the reinvestment rate, which was this 50%. So earlier the company was only earning 6% on these reinvestments. Now they're going to earn 9%, which is going to change uh, so by changing the existing the return on capital, you get from 6% to 9% to into 800, you get a 72 million expected EBIT into 1 minus T next year, right? So now because you're going to earn a greater return on capital and the growth expectation is still the same, therefore the company would require a lesser reinvestment. So that is when calculated by 3 divided by 9. 3 is the growth rate, 9 is the return on capital. So from a 50% return reinvestment rate, now the company only requires 33% of reinvestment. The rest is simple: 72 into 1 minus 33% divided by the new cost of capital minus 3%, which was your growth rate, comes out to be 916 million. So, quite a significant increase in value due to the changes that have taken place post the taking over by the new management. Okay, thank you.